Okay, good morning, everyone. Welcome to this week's Macro Monday call. It's week 33. We'll dive right in. My name is Andrew Bresler. I am filling in for KVP this week because he's on some leave, and I'll be assisted by James Kim as usual. So, standard disclaimers apply, solely views and opinions, not trading investment recommendations. We'll start today slightly differently with sort of a public service announcement, as it will. So Saxo has taken the view that due to increased geopolitical risks and tensions around the Korean Peninsula, we see that this risk has the potential of escalating further. While this is not our main scenario, the Market Risk Department has made the decision to increase margins across a range of instruments, which will happen on Wednesday at 8 a.m. GMT time. So we would ask that you please contact your relationship manager or your sales trader for further details on this, as obviously this will have impact pretty much across the product set that we have. And just a reminder on that we aim to increase margin requirements to protect both the best interests of our clients as well as the bank. And so the risk department feels it prudent to act accordingly in this instance. Diving into last week, so obviously the key being geopolitical tensions. They sort of started off with sanctions on North Korea by the UN, followed up by Trump with a fire and fury comment. He doubled down on that later in the week, saying it's not that comment was potentially not tough enough. North Korea responded in kind with threats to fire missiles on the US base in Guam. Japan sets up its missile defense system. Trump and Xi had a phone call on Friday night agreeing that North Korea must stop its provocation and commit to denuclearizing the Korean Peninsula. Ultimately, our view here is that the probability of an escalation remains low. However, it is much greater than it has been in previous months and years. And you'll see as we get through today's call, there's a number of key events in the coming weeks that mean that this risk is heightened. Then we had China data last week. That disappointed really. So exports and imports both missing expectations, so weaker trade month on month, still quite strong numbers year on year, but also lower CPI data and a miss on PPI data. CPI largely driven lower by a food price deflation. This has a few market participants talking about risks to the China outlook, and more importantly, a risk to China outlook, a risk to global outlook. I would say it's probably too early to call on that sense. But certainly something worth watching. On Friday, US CPI data missed expectations, so 1.7 was the headline number versus a 1.8 expectation. Core was in line. This then had a couple of Fed speakers, Kashkari and Kaplan. Kashkari saying, undershooting of inflation, why do we need to cool the economy, and more slack than we think there is in the labor market. So a theme that's becoming increasingly consistent from Fed speakers here is this questioning of the Phillips curve, i.e. the relationship between low unemployment and wage price inflation. We've seen that out of Bullard. We had Yellen open the door to that recently, and so potentially either there's more slack in the labor market than we initially thought, as you can see by the U6 versus the U3 unemployment numbers, but also this is driven, as Kaplan highlighted, that this is partly driven by technology, and so the advancement in technology is a deflationary pressure on the outlook. The net result of this is the probability of a rate hike for December declined to 38%. It was circa 50% at the start of the week, and the next hike is now only priced in for May 2018. Also in the week, we had the RBNZ on hold. As was widely expected. However, what was sort of more interesting from that was the follow-through from both RBNZ Governor Wheeler and his deputy McDermott, who talked about the potential for intervening in the Kiwi, the strength within the Kiwi, and this sent the Kiwi to be the worst performing G10 currency last week. German data turned down last week, misses industrial production and trade. That point to potential that the golden period for German data may be coming to an end. CPI data, however, was as expected. Worth monitoring the German data situation, as this has led the European outlook. So a weaker outlook for Germany may mean a weaker outlook for Europe. Some other Fed speakers throughout the week was Bullard, who was dovish as expected, and again Dudley raised a question on the Phillips curve.
Scandis, we had very strong industrial production data out of Sweden. That echoed the recent GDP and CPI data. We favor SEK longs as a function of this, and the idea that the Riksbank cannot remain dovish ad nauseum. They're at minus 50 basis points and still continuing QE, so they will probably have to change that in the coming weeks or months. Norway CPI surprised to the upside. From OPEC, there was a Bloomberg story over the weekend that highlighted that compliance with output cuts have fallen to 75%. This is a new low since the agreed cuts, and so crude ended the week lower last week by about 1% a bit. In South Africa, Zuma managed to survive his 8th consecutive vote of no confidence. So ZAR remains pressured and should remain pressured for the months ahead as we move into the ANC election in December. Running through some of the asset classes, as you can see here, a sea of red across the equity space. That's largely driven by this North Korean tensions. Europe was pretty hard hit. That's a function of geopolitics and a stronger euro. In Asia, obviously, unsurprisingly, the Kospi, the weakest performer, down 4.75% on the week, with some nearly $1 billion worth of outflows in the market. Nifty, one of the favorite trades globally in terms of asset allocation, was down 4.4%. VIX, the highest level since November 2016, when Trump was elected president. From Peter Garnery's call on Friday, our Friday markets call, Peter mentioned that evidence that he has seen suggests that above 22 tends to be a tipping point for markets. So watch that. The week high was 17.8. I think we closed around 15.5. Volatility was up pretty much across the board. However, you see fixed income volatility up circa 10%, FX volatility up 5%, and all of this on the back of geopolitical tensions. And in the fixed income space, buying of yields across the board, with 10 years closing below 2.2%. In terms of FX, unsurprisingly, safe haven assets performed well. So gold, the best performer, up 2.4%, yen 1.4%, Swissy 1.1%, risky currencies, Korea down 1.25%, and Kiwi, as I mentioned, on the back of RBNZ, much lower. Most interesting and a rare outperformance by the onshore Chinese renminbi, with it being the best performing EM currency against the US dollar last week. Question marks as to why this was, and curiously, China now concerned about inflows rather than capital outflows. Inflow data suggesting a recent move towards the positive there. So China's much stronger over the course of the week. Friday, we actually saw a higher than expected dollar-China spot fix, and that translated into actually some weakness on Friday. So this would have been much stronger throughout the course of the week. As I mentioned in the commodity space, oil lower on the back of both risk off but also a lack of OPEC compliance. IEA actually put something out saying they cut their OPEC's demand outlook. You may see some support coming in the oil space this week. Stories over the weekend highlighting that Libya oil output is down 30% in the last few days due to increased security threats. Another one worth highlighting is iron ore falls about 4.6%, giving up some of the recent gains it's had on the China stockpiling story. So the weak China data having an impact there. COT report will spend very little time on, only highlighting that euro and CADs continue at longs at the highest positioning in 52 weeks. US positioning remains broadly short. In the commodity space, copper, the only commodity which has a position at its 52-week highs. Gold longs continue to grow. We'd expect that to increase throughout the course of the week, given the safe haven flows that we saw last week. And we've seen a huge reduction in wheat shorts on the CBOT. You can see that positioning is now turned short. The week ahead, so the key events this week, we've got FOMC and ECB minutes. We also have the RBA minutes out of Australia. Sweden CPI, as I mentioned, this may be a turning point for the Riksbank if we have a surprise upside to CPI number in Sweden. UK numbers predominantly in the form of CPI. What will that mean for the Bank of England and their view on Hawks and Dove splits? And then you have on Thursday of this week the Aussie jobs numbers. In terms of central banks, only Bank of Thailand and Chile, no change expected. Kaplan speaks twice this week. You have RBA's Kent, who I believe has already spoken this morning, and RBA's Ellis, so pretty mild in terms of central bank speakers. Running through the data, today we have China retail sales, industrial production, and fixed asset investment as the highlights. We've already had retail sales from New Zealand and Japan. Tomorrow we have the Sweden CPI, we also have German GDP, and UK CPI, so busy day tomorrow, US retail sales. On Wednesday, there's the US FOMC minutes as the highlight. On Thursday, Aussie employment numbers and the ECB minutes as the highlight. And on Friday, you have German PPI and Canadian CPI. So I thought we'd spend a little bit of time on the North Korea threat, given sort of the increased margins, etc., a sort of broad what's happened to date. November 2013, we had 2016, a tightening of sanctions. 2017, Kim Jong-un says, that was January 2017, they're in the final stages of developing long-range guided missiles. April, US warns North Korea on its ballistic tests, and in July, Pyongyang test fires a long-range missile into the Sea of Japan. This is the 14th missile test of 2017. So, why the increase then last week? Well, on the weekend, you had UN sanctions increased against North Korea. North Korea strongly condemned these and threatened the US. Trump responded with a fire and fury comment. Like his words were, they will be met with fire and fury like the world has never seen. On the same day, the Washington Post writes a story that published a report by the Defense Intelligence Agency that says North Korea has successfully miniaturized a nuclear warhead which can be mounted on its intercontinental ballistic missiles. The following day, Secretary of State Tillerson says when Trump spoke of fire and fury, he wanted to avoid any miscalculation by Pyongyang. North Korea then threatened 4 intermediate range ballistic missile rockets on the US base in Guam, and plans will be ready by mid-August, so this week. Trump then doubles down on his comments, saying these fire and fury statements were not tough enough. And then on Friday, Trump tweets, military solutions are now fully in place, locked and loaded, should North Korea act unwisely. Similarly, the Japan prepares their missile defense shields, and you have a call between Trump and Xi Jinping promoting calm and peaceful solution. So clearly a significant move in terms of the ratcheting up of rhetoric around the North Korean threat. And so what we've got ahead of us is a couple of days where this threat remains particularly heightened. So today you have General Joseph Dunford, the chairman of the U.S. Joint Chief of Staffs. He will meet senior military officials along with the South Korean President Moon Jae-in. Tomorrow marks the anniversary of the end of Japan's occupation of the Korean Peninsula. This is a key annual event, the North Korean calendar, and it is typically renowned for provocation, military drills, and celebrations. So risks around here. And then next week, early next week, South Korea is to hold its annual military drills with the US. This is typically met by sort of acts of defiance by North Korea. I also saw an article this morning that's potentially highlighted that North is preparing for launching of submarine missiles. So a comment over the weekend from a Bloomberg News article: the US hasn't taken any public steps to prepare for hostilities, such as evacuating American soldiers from Seoul. The US has 28,000 troops stationed in Seoul, so that would typically be a precursor of an expectation of heightened conflict. So as remains the base case, the risk of a miscalculation has increased, largely due to a Trump factor. However, this risk remains still relatively small. Regardless, I would say that prudence advised. So at Saxo, we're advising sort of decreasing some of your exposures, looking at putting on hedges in the forms of both gold and Swiss, and spending a bit of premium to protect some of your gains or the downside. I mean, potentially the North Korean threat and the ratcheting up is an excuse to pay back some risks, as valuations potentially don't justify current prices. So we would advise that this potentially has a risk to roll on for another couple of days or weeks, given the aforementioned drills, etc. So caution advised. And with that, I will hand over to my colleague James Kim.
Thank you, Andrew. After finding support at the 2015-2016 base, as well as the 200 weekly moving average 2 weeks ago, the small bounce we saw last week over the US dollar index proved to be short-lived as sellers re-emerged to take control over the US dollar. Every attempted rally last week proved to be useless, as you can see by the daily pins here. The US dollar continued to fail to close at its session highs all throughout last week. There are two downside levels that it's likely to hold selling in the week ahead. Attention is first at 92.65. Or the 76.4% retracement level, followed by 92.30, or that fresh 2017 low we saw most recently. To the top side, initial resistance will be encountered at 23.33, followed by last week's high at 93.79. Only a break above this level here would reassert continued upside bias. Now, for those that seek opportunities to turn positive over the US dollar index, we look for a higher swing low to form. And should we see that lower swing, a higher swing low come here at 92.65, then the technical setup will be highly encouraging for further strength ahead. The euro in the past week was able to close above its 200 weekly moving average. This should continue to lend positive momentum to the start of the week at least. The retracement we saw last week yet again proved to be extremely shallow, as the euro was supported at a short-term June-July trend line. The week ahead test remains for the euro to claim another 2017 high above 119.09, and above here the 2012 previous swing low here will be keenly watched as a potential point of resistance. Any sell down should continue to find technical support along that June-July trend line we saw last week. The aggressive rally we saw over the dollar CAD since finding a base just below that major May 2016 low saw gains find resistance in the past week at the very first 23.6% retracement between the 2017 all-time highs to the recent lows. The dollar CAD also traded in a key outside day reversal on Friday. This sets the path for a retracement in this week ahead. We look to sell any rallies for a tactical short, preferably at 127.30, with a buy stop above here, above last week's high at 27.51. We look to cover all existing short positions at 25.75 here, which was the very first point of resistance for the dollar CAD after it found a new low in July. A healthy retracement for the Aussie dollar below the 200 weekly moving average continued before finding support at a key 2016 historical weekly resistance level. The daily chart shows that the Aussie is now will close below the original May, June, July resistance trend line. The initial test was for this to trade above here, which is what we're seeing here in Asia. And a close above here would be needed for further gains ahead. Above here, this trend line, we see the Aussie to be challenged at 79.44, followed by 79.78. A close above the 200 weekly moving average or the 80 handle is necessary for a new high to be seen next week. Continued selling over the dollar yen in the past week saw a pause at the 50% retracement level between the 2016 low to the 2017 high, as well as the previous June swing low. And for now, it has formed a potential double bottom here on a weekly chart, and a break below here opens the all-time 2017 lows here at 108.12 as the next support. Gains are expected to be capped at 110 initially. This should be decent resistance, as we saw the amount of support originally at these levels here. For now, given the double bottom formation and the rally off its lows, risk is to the top side on the dollar yen for the session ahead. A very quick look at the US 10s before we move on to equity indices. Our topside target of 126.21 was achieved last week. This technical level did not offer a chance for the US 10s to pause for breath. Instead, the 76.4% retracement level was ignored. Prices extended beyond here to settle at levels last seen in June. 127.08 or the 2017 highs will be the focus this week. On further strength, should we get it, and a break above here would open up a lot more aggressive gains for the US 10 years. After weeks of cautious consolidation at the 2015 highs, the Nikkei finally let go as the dollar yen was under extreme pressure in the past week. Selling found support at the previous May swing low, which happened to interestingly coincide just above the 200 daily moving average. We look for a tactical retracement in the week ahead, and I believe we are getting one already here in Asia, with gains to find resistance at 12,688, followed by 19,688, followed by 19,810. Downside support is served at the 200 DMA again this week. Our comments from last week for the ASX 200 was that we wouldn't expect any change to the way our index has traded from May. Choppy trading and continued consolidation between the 200 DMA here as support and 5800. An attempted rally in the week that we just saw, it saw fierce selling at 5800 or just below here, which prevented our index from going higher above 5800. And the selling drove the index down yet again to the imported 200 DMA, which has continued to hold losses since June, as you can see. Our comments remain unchanged from last week, only a break either way. So above 5800 or below the 200 DMA is expected to then set a proper trend for the Aussie index. And we would expect the follow through either higher above 5800 or lower below the 200 DMA to be strong in nature. Over to the E-minis. After breaking above the mini pennant formation that we highlighted last week, and this was a very small consolidation, the S&P went on to print a fresh 2017 high before experiencing a key reversal candlestick. This was the turning point for the index the previous week. The aggressive selling drove the S&P below the short-term April, May, July support trend line. Friday's attempted retracement failed to see the S&P settle above here, and the settlement to be seen here remains a challenge in the coming sessions. We expect resistance or a lot of noise here along this trend line with a positive push to then challenge the S&P at the following retracement levels. However, my focus will be on 24.59, the 50% retracement level, where we saw an initial huge push down in July to find support here. Final chart of the day, gold. The break of the 2011 trend line is now fully confirmed, as the weekly settlement last week was its third weekly consecutive settlement above this trend line. Now, initial selling last week saw this trend line come in to lend strong support over gold, and then gold continued to remain firmly bid going into the Friday close. The daily chart shows that gold's rise from the July low has surpassed the previous range in gains, which lends support to our argument for further strength. The previous 2017 resistance, which led to a double top to be formed, is currently right in front of gold at 12.95. This remains the first upside test. Now, given the aggressive rally, the run that we saw over gold last week, and the attention that traders will give to this previous double top, an initial retracement to the downside is more likely before it breaks higher. And a break of this 12.95 level opens blue skies for gold up to at least 13.26. Which was the highs that we saw on the US elections around here in the week or even weeks ahead. That brings us to the end of the macro week ahead. Again, reminding our clients of the margin changes on Wednesday. Any questions or any support needed around those margin changes, please reach out to your relationship managers or to your sales traders. A recording will be made available if we want to run through some of the comments from today. I'm wishing everyone a safe and profitable trading week ahead. Thank you.